Welcome to the Opening Bell Report.
If you're tracking the microcap markets right now, you already know the sheer velocity we've been seeing lately.
Oh, absolutely. It is a highly aggressive environment right now.
Right. You wake up, you check your terminal, and suddenly a ticker you've been casually monitoring has just gone completely parabolic.
Out of nowhere.
Exactly. We're talking about a multi-month consolidation phase that suddenly violently breaks out, nearly tripling in value in a matter of hours.
Yeah, the adrenaline, the tape reading, the rapid repricing of risk, it forces you to recalibrate your screens, regardless of what sectors you typically weight your portfolio toward.
Welcome to today's deep dive. You sent us a stack of research centered on a very specific, very explosive market event, and our mission today is to tear into the mechanics behind it.
Because when a dormant microcap suddenly monopolizes intraday liquidity like this, there is almost always a complex web of structural market dynamics at play.
And fundamental catalysts, yeah. So the focal point of the analysis report you provided is Actelis Networks, Inc. For those of you tracking the ticker, that's NASDAQ Q symbol ASNS. And the analysis report is literally titled, ASNS Stock Explodes plus 186% in a single day. Here's why.
Which is quite the headline.
It is. But we're going to dissect exactly what triggered that violent jolt. We'll examine the fundamental catalyst, the underlying technology, the structural market mechanics that fuel the squeeze, and, most importantly, the balance sheet realities currently acting as a massive headwind. Okay, let's unpack this.
To really understand the magnitude of this specific shockwave, we have to look at the microstructure of the trade on that particular day.
The raw numbers.
Exactly. According to the data in the analysis report, we are looking at a stock that had been heavily battered. Suffering through a prolonged downtrend that pushed it entirely off the radar for institutional money.
And mainstream retail, for that matter.
Right. But on this session, ASNS opened at just 41 cents.
41 cents.
Yep. And from that depressed baseline, it violently surged to an intraday high of 73 cents before pulling back and settling at 54 cents by the closing bell.
But hold on. What really stands out to me in the data isn't just the percentage gain from 41 to 73 cents. It's the sheer velocity of the tape.
The momentum.
Right. This wasn't a steady organic accumulation phase by some value fund. When you look at the intraday chart, you see a massive volatility expansion.
Oh, retail momentum traders definitely caught the set.
They did, but a move that violent implies heavy algorithmic participation too.
Definitely.
Once the high-frequency trading algorithms identify that kind of sudden order flow imbalance and the news momentum, they aggressively scale in.
Which triggers further breakout scanner.
Exactly, trapping any existing short sellers and forcing a classic momentum feedback loop.
And that feedback loop is exactly what drove the most staggering metric in this entire analysis report.
The volume.
Yes. It wasn't just the 186% intraday peak, it was the volume. In a single trading session, over 109 million shares traded hands.
109 million. Which is absurd when you look at the historical baseline.
It's massive.
The analysis report points out that the 3-month average daily volume for Actelis was hovering right around 16 million shares.
Right.
So you are jumping from a relatively sleepy 16 million to 109 million in the span of a few hours. That kind of liquidity doesn't just materialize out of thin air.
No, it doesn't. And what's fascinating here is the implication that volume has on the outstanding share supply.
Break that down for us.
Well, when you cross-reference the 109 million share volume against the actual tradable float for ASNS, it means the entire available supply of equity rotated multiple times.
Before the afternoon session even really got underway.
Exactly. Every single available share was theoretically bought and sold several times over in a matter of hours.
It's pure tape churn. And usually, when we see this in the sub-dollar microcap space, it's a completely hollow move.
A low-float momentum pump.
Right. Driven by a coordinated social media push or some vaguely worded press release that doesn't actually impact the company's bottom line. But here's where it gets really interesting.
Because it wasn't a hollow pump.
No. The analysis report makes it clear this liquidity event was ignited by a tangible, highly lucrative fundamental catalyst. Actelis secured a newly minted purchase order from Caltrans.
The California Department of Transportation?
Exactly.
And municipal and state-level government contracts are often the holy grail for a company of this size.
Oh, absolutely.
The analysis outlines the scope here. This specific purchase order is integrated into a massive $120 million infrastructure modernization project targeting San Mateo County.
Right, but let's play devil's advocate for a second.
Okay.
The analysis report highlights this $120 million San Mateo project, but we need to be realistic about procurement. Actelis isn't suddenly pocketing $120 million.
No, not at all.
They are a vendor. They are supplying a very specific technological bridge within a much larger multi-contractor ecosystem.
Right, the total project budget is $120 million.
But their actual slice of that revenue pie is going to be significantly smaller.
Spot on. That's a crucial distinction that the broader market often misinterprets during these initial breakout phases. Actelis is capturing a vendor fraction of that total capital expenditure.
Right.
However, the reason Caltrans brought them into the fold, and the reason local governments are aggressively pursuing their tech, is what truly validates the initial bullish thesis.
The Metalite platform.
Exactly. They are utilizing a platform Actelis calls Metalite.
Looking through the technical specs in the analysis report, this is where the engineering actually solves a massive bureaucratic headache.
It really does.
Metalite essentially delivers modern fiber-like broadband speeds, but it does so over existing legacy copper network infrastructure.
Which is an incredibly disruptive value proposition.
It changes the math completely.
It does. Think about it. If you are a municipal planner or a state transportation authority, your alternative to achieve those data speeds involves a staggering amount of capital expenditure.
You'd have to tear up the streets.
You are looking at commissioning environmental impact studies, hiring massive contracting crews, trenching miles of asphalt.
Navigating complex right-of-way negotiations.
Exactly, and causing months of traffic disruptions just to physically lay down new fiber optic cables.
It's an absolute logistical nightmare. Anytime a city has to physically dig up infrastructure, the budget inevitably balloons, and the timeline extends by years.
Decades, sometimes.
Right. And Actelis is effectively walking into these municipal planning meetings and offering a bypass. They provide the hardware and the software-defined networking capabilities to interface directly with the obsolete copper telephone wires.
The ones that have already been sitting under the concrete for 50 years.
Exactly. They bridge the legacy copper to modern data standards without a single shovel hitting the pavement.
And the CapEx savings are immediate and quantifiable.
Massive savings.
By circumventing the physical trenching and environmental friction, the Metalite platform preserves millions of dollars in municipal budgets. The analysis report correctly identifies this as the core driver for the technology's adoption. It's not just a marginal improvement in data transmission.
It's a structural workaround to a heavily capital-intensive problem.
Exactly.
When you frame it like that, saving California millions in hard excavation costs while immediately upgrading the grid, the sheer violence of that 186% stock surge makes absolute sense.
The market recognized the utility.
The algorithms and the momentum traders saw a definitive validation of the technology via a state-level actor. So what does this all mean when we let the dust settle?
That's the real question.
Because as thrilling as that intraday squeeze was, the data you provided forces us to look very soberly at the immediate aftermath.
The post-surge reality check is arguably the most vital part of this deep dive.
The hangover.
Right. The market is ruthlessly efficient at repricing these events. Following that massive spike to 73 cents, the profit-taking was aggressive.
Very aggressive.
In the extended after-hours session, ASNS bled out, dropping over 18% to trade down around 44 cents.
Which means if you were a momentum trader who got caught chasing the tape near the highs, you were immediately underwater.
The chart printed a brutal reversal.
Yeah, you saw a massive upper wick on the daily candlestick chart.
Right. That technical footprint shows us that the initial algorithmic and retail buying pressure was immediately suffocated.
Early accumulators aggressively sold into the strength to lock in their intraday gains.
And it's highly probable that structural short sellers stepped in at the highs, betting on the historical probability that the microcap wouldn't be able to hold those levels.
And when you pivot from the technical chart to the income statement, you instantly see why those sellers were so eager to exit the position.
The fundamentals.
The underlying fundamentals right now are conflicting at best. On the top line, the revenue growth looks solid.
Year-over-year sales expanded by 38%.
Right, hitting $7.8 million. But then you look at the operating cash flow, and it is a complete bloodbath.
It is the defining dilemma for emerging hardware companies.
It really is.
The analysis report drives this point home with a very stark observation regarding their operating margins. Currently, it costs them more than $1 to make $1.
I'm glad you brought that up because that is the exact line in the research that should give any institutional investor pause.
It's a huge red flag.
You can have the most disruptive, CapEx-saving copper technology on the market. You can secure purchase orders from massive state entities like Caltrans.
But if your fundamental unit economics dictate that you burn cash on every deployment,
your top-line revenue growth is practically irrelevant.
Exactly. And if we connect this to the bigger picture, it exposes the most severe structural vulnerability Actelis is facing.
Which is?
This isn't just a matter of tightening up operational efficiencies. It's an existential challenge regarding how they fund their own growth.
It's the ultimate catch-22 of government procurement.
Yes.
Winning a vendor contract for a $120 million Caltrans project is phenomenal for your press release and your stock's intraday volume.
It looks great on paper.
But the reality of government contracts is that they operate on incredibly slow payment cycles. Net 60 or net 90 terms are standard, often tied to specific deployment milestones.
Caltrans isn't fronting Actelis the cash.
Exactly. Actelis has to finance the hardware manufacturing, scale up their supply chain, and execute the deployment before they ever see a dime of that state money.
And this is precisely where the balance sheet metrics provided in the analysis report become highly restrictive.
Let's talk about the liquidity.
If you look at their current liquidity, Actelis is sitting on roughly $2.0 million in cash.
Okay.
Against that, they are carrying $5.2 million in liabilities.
$2 million in cash against $5.2 million in liabilities. That is zero breathing room.
None at all.
When you are operating with negative cash flow and you suddenly have to spin up inventory to fulfill a high-profile state order, that $2 million is going to evaporate instantly.
Almost overnight.
So the obvious question for anyone holding this equity is, how do they capitalize the manufacturing?
That is the exact trap that micro-cap investors constantly fall into.
Right.
When a company with an upside-down balance sheet experiences a sudden, explosive 186% surge in its share price, management and their underwriters view that liquidity event as a lifeline.
It's a golden ticket.
Exactly. It is the optimal window to initiate dilutive financing to raise the working capital they desperately need.
They tap the equity markets. Whether it's through an at-the-market offering facility, a shelf registration, or a private placement with warrants attached, they are going to print new shares.
They have to.
But we need to be clear about the mechanics here for you listening. Issuing new equity directly punishes the existing retail base that just bought into the breakout.
It absolutely does. It immediately dilutes the earnings per share and shrinks the fractional ownership of every existing shareholder.
Which the analysis report emphasizes as a specific risk.
Yes. While a capital raise is fundamentally necessary to fulfill the Caltrans contract and keep the lights on, flooding the market with millions of newly minted shares suppresses the bid.
It creates massive overhead supply.
Exactly. Supply that can drive the stock price right back down to its pre-catalyst baseline or even lower.
It's a brutal cycle. The company secures a monumental win, the stock goes parabolic, management uses that manufactured liquidity to dump shares and fund the win.
And the traders who believed in the technology get crushed by the resulting dilution.
It's exactly why the analysis report urges strict caution, despite how genuinely impressive the Metalite platform is.
It perfectly encapsulates the dual nature of this specific market event.
How so?
Well, on the fundamental side, Actelis Networks proved that their bridge technology has massive real-world utility for major infrastructure projects.
Definitely.
Securing the Caltrans order validates the thesis that local governments are actively seeking alternatives to expensive fiber trenching. It entirely justifies why the stock hit the scanners and attracted that initial 109 million share volume.
The tech is undeniably real.
But
the equity vehicle representing that tech is incredibly perilous right now.
That's the reality.
So, based on the data in the report, who is this stock actually appropriate for?
The consensus from the analysis report is definitive. ASNS remains a highly speculative, high-volatility micro-cap play.
Not for the faint of heart.
Not at all. In its current state, it is strictly a momentum trader's arena. If you are managing risk tightly and playing the intraday volatility, the liquidity provides opportunity.
But for a long-term fundamental investor,
The data strongly suggests waiting on the sidelines. You need to see exactly what terms management accepts to fund this Caltrans contract.
right.
Until that dilutive overhang is resolved and the cash flow metrics show a path to parity, the risk profile is simply too elevated.
You essentially have to let the company navigate that treacherous valley of death
Sure.
between securing the contract and actually stabilizing their balance sheet.
Yeah. This raises an important question, and it's a structural issue that extends far beyond Actelis.
Let's hear it.
It highlights the fundamental, often fatal gap that hardware startups face. How do you survive the capital-intensive lag between winning a company-defining infrastructure contract and actually recognizing the revenue without totally decimating your shareholder equity through toxic financing?
It's the great filter for emerging tech companies.
It really is.
And looking at how Actelis is attempting to cross that gap leaves you with a really compelling thought to chew on.
Oh.
Yeah, think about this. If they can utilize software-defined networking to unlock modern high-speed data from 50-year-old obsolete copper wire buried beneath the asphalt,
Right.
What other legacy infrastructure is currently sitting dormant right beneath our feet? What other forgotten physical networks are just waiting for the right hardware bridge to suddenly become incredibly valuable real estate again?
That is a fascinating way to look at it.
It forces you to look at the physical grid of your city through a completely different lens. Thank you for sending over this research. It was an incredibly sharp look at the reality of microcap mechanics. We'll catch you on the next deep dive.
Don't forget to like, share, and subscribe for more.